The Great Depression saw output collapse, unemployment soared, and democracies literally falling apart. It was the greatest economic disaster of modern history. And yet, in the summer of 1929, literally nobody was predicting the cataclysmic event which was just around the corner. But on the 24th of October 1929, Wall Street started to crash, beginning the descent into depression. But how did we go from this stock market crash to global Great Depression? Well, in the aftermath of the First World War, the UK economy was really battered, and the US economy was becoming the dominant industrial power. But that post-war period involved a system known as a gold standard. This pegged the value of a pound against the dollar at a completely unrealistic level. John Maynard Keynes called the gold standard a barbaric relic of the past, and said that Winston Churchill's decision to rejoin in 1926 doomed the UK economy, and he was right. In the gold standard, the UK had an overvalued exchange rate, very high real interest rates, and this caused deflation, rising unemployment, and a prolonged recession even before the 1930s. The United States economy was completely different. In the 20s, the economy was booming. Automobiles produced with such great efficiency, even average workers could start to buy them. It was a roaring 20s, the American dream. But to keep the dollar weak against the pound, US interest rates were kept very low, the money supply grew, and savers looked for better returns on the stock market. As shares soared in value, it seemed to be a one-way bet, and the euphoria of doubling your money caused people to put everything into buying shares, even if they had to borrow to get in on the action. But by October 1929, the booming economy was starting to fade, and when firms reported disappointing profits, market sentiment suddenly changed. More savvy investors realized it was time to get out, and waves of panic spread across Wall Street. By 1932, the stock market had fallen 89% from its September 1929 peak to levels last seen in the 19th century. Falling share prices caused a collapse in confidence, a loss of wealth. And with people losing money on the stock market, savers needed to withdraw more money than usual. But the real problem was the collapse in confidence around the banking sector. At that time, the US banking system was highly deregulated, with no central bank acting as lender of last resort. Banks only kept a small percentage of their assets in cash in the bank, and when rumours and panic started to spread that banks may go bust, people, of course, rushed to the bank to withdraw their savings. But the problem is that banks didn't have the liquid cash to meet the demands of all the people wanting to withdraw money. So the fear of bank collapses became self-fulfilling. In the first 10 months of 1930 alone, 744 US banks went bankrupt, with savers losing their savings. In a desperate bid to raise money, the banks then tried to call in their loans before people had time to repay them. This further decreased economic activity and reduced confidence even more. And as banks went bankrupt, it only increased the demand for other savers to want to withdraw money from their bank before the same happened to them. Now, a really good question is, why didn't the government just bail out the banks? Well, at that time, there was really a sense that governments should just not get involved. Famously, the Treasury Secretary, Andrew Mellon, was reported to have said, "Liquidate labour, liquidate stocks, liquidate farmers, liquidate real estate. It will purge the rottenness out of the system. People will work harder, live a more moral life." Now, the quote is actually disputed, but it does actually reflect the laissez-faire ideology of the time. In 1930, wealthy bankers were actually really worried and looked into bailing out the Bank of the United States. This was actually a private bank based in New York, specializing in loans to Jewish and Eastern European immigrants in New York. It had over 400,000 small-scale depositors. But the likes of JP Morgan and First National Bank decided to not bail out the bank for a number of reasons. They feared revealing hidden losses from the 1920s real estate boom. There was a fear of creating moral hazard, the idea that saving weak, failing banks would only encourage more bad lending practices in the future. Also, of course, underlying that was an ethnic prejudice about bailing out immigrant savers. As a result, $200 million in deposits were frozen, a huge sum in those days, but it caused ripple effects throughout New York and then later spread to the rest of the country. You could no longer trust the money in your bank. Many argue that a decisive bailout in the early stages could easily have changed the course of the Great Depression and prevented all these terrible losses of money. But the combined effect of bank failures, collapse in lending, fall in asset values was a sharp fall in the money supply and normal economic activity. This led to deflation. Prices fell. Things were cheaper, but it was a disaster because with falling prices and falling wages, consumers delayed purchases because goods will be cheaper in the future. And combined with falling confidence, this all reduces demand, slows down economic growth, and pushes down prices further. The deflation also increased the real burden of debt. When prices and incomes fall, debt repayments become harder to repay. Thirdly, deflation raises real interest rates. Even with interest rates near zero, falling prices push real rates even higher. And all this deflation, falling demand, and collapse in investment led to a rise in unemployment. It went from zero in 1929 to over 25% in 1932, indicating the severity and seriousness of the economic decline. But as unemployment rose, demand fell even more because this was a time of minimal government intervention or benefits. In the 1930s, the unemployed received little more than going to a soup kitchen to get a bit of free food. Therefore, the unemployed, and there were millions and millions, dramatically reduced their spending, causing lower demand and knock-on effects throughout the economy. And as America slid into recession, they recalled its loans to Europe it had made after the First World War, and this spread the recession to the whole world. And of course, this was exacerbated by imposing extremely high tariffs in 1932 with the Smoot-Hawley trade restrictions. The gold standard aggravated the depression because countries didn't have the freedom to cut interest rates or increase the money supply. They were tied to the value of gold and they couldn't inflate their economy. And interestingly, countries who left the gold standard the quickest almost immediately started to see economic recovery. Now, there are different views about the Great Depression. Monetarists highlight the importance of a fall in the money supply. They point out between 29 and 32, the Federal Reserve allowed the money supply to fall by a third. Keynes emphasized the importance of a fundamental disequilibrium in real output. He saw the Great Depression as evidence that the classical models of economics were flawed, and he made a very strong case that the government should intervene to kickstart aggregate demand and not just let the economy remain in depression with mass unemployment. The Marxist view saw the Great Depression as heralding the imminent collapse of global capitalism. They pointed to the Soviet Union, one of the few countries which was able to overcome the Great Depression through state-sponsored economic planning, although it is worth pointing out also the fascist countries of Italy, Japan and Germany, who spend extensively on rearming, were also some of the most successful countries in overcoming the recession. But worth pointing out, you don't have to spend money on arms to kickstart the economy. You can also get the same effect by spending on education and healthcare. Now, could the Great Depression happen again? Well, I think that a downturn on the same scale as the 1930s is hopefully very unlikely. The Great Depression was really exacerbated by collapsing bank system in America, but also the gold standard, tariff wars and extreme fiscal austerity. You would hopefully never see the kind of bank collapses which were so devastating to the US economy in the 1930s. If there's one thing that's been learned from that period, is that you shouldn't allow normal banks to go bankrupt. Now, in 2009, after the devastating credit crunch, the US authorities did allow Lehman Brothers to collapse. And that was a big mistake because it suddenly created all this panic throughout the world. And it's why the UK government had to start bailing out big banks like Northern Rock. Nevertheless, although we have learnt some lessons, severe recessions do remain possible. Banks may be more regulated, but we've still got large pockets of risks which have often moved to the shadow banking system, private credit funds, hedge funds and non-bank lenders. Also, all the very high global debt levels, possibility of asset bubbles and dependence on AI-related investment do present new vulnerabilities. price to earning ratios have arguably become divorced from reality, at least in the United States. And any kind of system-wide shock, such as an energy crisis, a cyber attack or geopolitical conflict, could trigger that collapse in asset prices, which trigger deep recessions. So a modern depression would likely look different. Instead of mass bank failures, it might involve a freeze in credit or the non-bank financing sector. But social safety nets would cushion the blow to some extent. So although unemployment will rise, hopefully would not reach the 1930s levels. But anyway, it is a very interesting economic period because it teaches us so much about economics, what works and what doesn't work. Anyway, thanks for watching. See you soon.